That's Bharat Forge for you. Happiest Minds is also on our radar. The company reported a good top-line growth, but margins have contracted sequentially. Also, they're saying that they will update their FY24 revenue guidance of 25% in October because they're still waiting for some acquisitions to play out. I caught up with the company's MD and CEO, Venkatraman Narayanan, and the Executive Vice Chairperson, Joseph Anantharaju. I began the conversation by talking about their FY24 guidance. Listen in.
The acquisition pipeline that we had companies ranging from $10 million to about $40 million. And this is what we had factored in while we talked about revenue guidance of 25% for the current year. If you recollect, we don't divide our revenue growth aspiration or guidance for the year as organic and inorganic. It's the amalgam of both of them. And we had these couple of companies which we hope to close to add to the revenue numbers. And that's the background for making that statement, because we have done about 4.7% growth in Q1 with regard to total income, 3.6% in operating income and in dollar terms. When you compare that with, let's say, a 25% growth, people are going to ask you, where is the balance going to come from? So that was the logic behind having to clarify upfront as to what we had baked into our numbers of 25% for the current year. And also, we have always been saying that our aspiration to grow 25% into a $1 billion company by 2031 has got both elements of inorganic and organic growth.
Why has it been so hard, Venkat, for you to close these M&A deals? Is it because the potential target is asking for higher valuations? Because your pipeline of companies, potential companies, is very robust.
That's right. Expectation mismatches are there. But more importantly, we need to have a meeting of minds with regard to how they will integrate into our business. It's because in services business, it's all about people. So there has to be this alignment of people. Once that's done, you need to make sure that the company that we get on board into the Happiest Minds family is properly aligned to the way we do business. Because the typical structure of a deal is you pay a certain amount upfront and then there is a deferred payment over a period of, let's say, 2 or 3 years basis performance. You need to also make sure that you set them up for success and they make those earn-outs. And it's very important. Otherwise, these acquisitions tend to fizzle out after the couple of years that they have. After the first 1 or 2 years, if they see that it's becoming increasingly difficult to make those earn-outs and related earn-outs coming out of it. So one needs to really play very carefully. There are people elements that need to be taken care of. So yes, valuation is one key point, but more important is to see how we can align the acquired company into our business and we can get buy-ins so that they see that the earn-outs that are being promised are made.
Okay, so valuation and perhaps culture issues. Joseph, Q1 revenue growth in constant currency has been about 13 to 14%. Is that the organic revenue growth rate for the rest of the year? Do you see the macro improving, worsening? What's your read for the next 3 quarters? And can you explain the margin drop that we've seen sequentially?
So first, give a little bit of color on the revenue growth that we've had and where we see opportunities for the remaining 3 quarters. As you would have seen from our result, I think the 2 verticals that have done well for us, 3 verticals, I would say, EdTech, BFSI, and healthcare, which we've started calling out as a separate vertical, and we've had a few closures in that vertical. If you look at EdTech, we've had closures both in India and in US. And it's been both new customers and growth in existing customers. BFSI, again, the segment that we played in, it's not the large banks, and we've seen good growth out there. Healthcare and life sciences, there are multiple segments out there where we've been able to build capabilities and depth, and I think that will continue to be an area that will give us growth.
Joseph, since you spoke about the 3 sectors where you've seen growth, I would like to draw your attention to the 3 verticals where revenues have contracted. One is high-tech, where revenues are down 21% quarter on quarter, and the other 2 are travel and retail, approximately a 5% decline. What led to that?
So if you look at the high-tech vertical, there's a reclassification that's happened out there. So earlier we had classified some of our health tech companies in high-tech, and if you notice, healthcare now is 12.6%. So we had a couple of accounts from manufacturing and a few accounts from high-tech that got reclassified. If not for that, I think the percentage of revenue, the revenue share of high-tech would have stayed the same. As far as retail is concerned, we had one large customer in the Middle East, which was a PIMCore implementation that came to an end in Q4, and we had talked about it in Q4 as well, because it had, we had seen a drop from Q3 to Q4, and that totally closed down in Q4 actually, and that's what you've seen in Q1 getting reflected in terms of a drop. Otherwise, we've had a couple of customers in the retail CPG segment that have ramped up quite well. One of them being one of the top 3 CPG companies in the world. On travel and media and entertainment, it's mostly media and entertainment because we have very little travel business. And here, one of our large customers, they're going through a name that is very well known. They're going through their own internal reorganization and re-strategization, as a result of which some of the new initiatives have been put on hold, and they've gone through a round of cost cutting, and that's what you see reflected in some of the numbers out there. But we expect this to be a temporary phenomenon, because end of the day, some of the work that we're doing for them on streaming TV and analytics, those have to continue, and they have to take these to market.
Venkat, very quickly, could you tell us what led to the margin contraction and the guidance on margins?
Guidance on margins, we continue to hold that between the range of 22 to 24%. And there's a 13th quarter in succession, we have beaten that, and we have been ahead of 25%. Going into Q2, we have the wage increases coming in effective 1st July, so there won't be a temporary, I would think, a contraction in margins, and we'll have to make that up through volume and value growth, rate growth, as we go into the quarters of Q2 and forward. As far as Q4 to Q1, the slight dip in margin was on account of the wage adjustment, because we had slight increase in the on-site part of the business. That's one. And the second thing is, typically in the fourth quarter, you have some reversals coming in on account of provisions that get reversed, like the variable pay or sales incentive kind of thing. So that contributes to a percentage and on, or even lesser. But it does contribute to wage cost in the fourth quarter, because you even the cost out over the 4 quarters, assuming a certain achievement, and that there will be reversals in some heads and there will be catch up in the other. In Q4, there was a little more of reversals, I would say. And other than that, there is no change between the last quarter to this quarter.
Okay, that's the word coming in from Happiest Minds. Let's now focus on the mutual fund data that we just